Hello, everybody. We will be today talking about making money with the automated lease purchase system. We'll be discussing how to make money with the ALP system. The ALP system profits are available in three ways. When number one is when signing the contract, number two is throughout the contract, number three is upon the sale of the property. So number one, the option fee, which is received on the signing of the contract. When you sign the contract, you receive a consideration, which is an option consideration for the option to purchase agreement, which means the tenant buyer is giving you the deposit for considering to sell him the house in 1 to 3 years at a certain amount which is agreed in the contract. The tenant buyer pays this money as the initial payment when concluding the leasing option. Some people call it a deposit option, and I used to call it a deposit option because similar terms are applied in the normal agreement of purchase and sale. So you think that calling it a deposit might have some legal applications, as a deposit can be refundable. Yes, it can be. So in contrast, an option fee is a option consideration which is technically non-refundable. So depending on the contract, we normally use is lease option fee instead of just the deposit. So number two is throughout the contract. Typically, contracts allow you to make money throughout the contract because you receive more money than you're paying for your mortgage, property taxes. If you're leasing, then it's for your lease because you may lease and then sublease it to the tenant buyer. So depending on how long you wish to conclude this contract, the option agreement, the contract is normally 3 to 5 years. Normally we conclude the open contract for 3 years, which means the tenant buyer will buy the property within the 3 years. So there could be an amount which we add as our monthly profit on top of the mortgage payment, property taxes, and insurance. And this is discussed openly with the tenant buyer because we are helping them get a house in which they are going to be living. So it can be a few $100s depending on the property and the investment amount and the situation of the tenant buyer. So number three is upon sale of the property. When you sell a property, you get money in the ALP system because each year the appreciation is added. So which is added to the purchase price. The return profit is the difference between what you purchased the property for and what you're selling it for. For instance, the difference can be between $45,000 to $100,000 depending on, let's say you bought the property for $300,000 and you're selling it for $345,000. So then the profit is $45,000. If you structure the deal correctly, you can make a lot of money with the ALP system depending on the agreement. Normally I make anywhere from $30,000 to $100,000 per deal. We'll discuss the three ways in the following in detail. So let's discuss what kind of profits can you expect at the term of signing the contract. Remember, money is made when you purchase the property, not when you sell it. You realize it when you sell it. So in every possible way in our ALP system, we try to make the money upfront. So this gives us an added security. So let's discuss that going forward. As we discussed, the first way to make money is through the option fee, which is option consideration, the cash that your tenant buyer puts when entering into the agreement. The amount required for the deposit or the option fee differs significantly from the standard renter amount. A normal tenant pays the first and perhaps the last or the security deposit. But when you are doing ALP lease option agreement, you are almost taking like 6 months to 1 year of payments as the deposit, which helps you and getting the added security. So when you use the ALP system or the agreement, the deposit is usually called the option fee, and which is a considerable amount. It can range anywhere from 15,000 up to 70 or even 80,000 we have seen in our contracts. The tenant buyer can purchase the property for a specific amount using this consideration fee. And that's why, because we are giving this option, we want this option fee to be considerable so that they don't pull out easily and that they're serious about purchasing the property, and they're not just renting the property, but they will be purchasing this property. And that's why this option consideration has to be reasonable. And a lot of rent to own people, means other companies who are doing the rent to own, they make this mistake. The option fee is very low, like option fee is $2,000 or very small amount, and the tenant can change the mind at any time and just forgive this 2,000, and then as an investor, the investor stands to lose. But in our case, we pay very special attention to make sure the tenant buyer is serious in getting into this contract and is paying considerable amount to stay in the contract and to eventually purchase the property. Let's say the house that you are buying for the tenant buyer, or you already own that house, or you are thinking of leasing it and then getting it under the option to purchase, and then doing the subleasing and doing another option to purchase, which is called sandwich lease. If you're doing that, we'll be talking about those techniques down the line, but don't worry about that at this moment. So let's say the house is for $300,000. And you agreed with your tenant buyer that they will buy it within the 3 years for $345,000 or in 3 years. If you use the ALP system and to structure the purchase, the tenant buyer has the option to buy at $345,000, giving you an option consideration fee. This option consideration fee is normally 5% or more, so the tenant will end up paying you about $10,000 to $15,000. Normally, due to the hot market and due to the increased risks these days due to COVID-19, we take minimum option fee of $20,000, and this kind of gives us an added security. You might be wondering and thinking, why would somebody pay you $10, $15, $20, or $30 or $50,000? Why can't they just go and buy? And I can tell you, majority of the cases, it varies from case to case. And let's say, for example, a customer has $10,000. That's not even 5% of the $345,000. Majority of the banks will require 5 to 20% deposit, depending on your credit history, depending on their current situation, depending on all their current status. And especially due to COVID and this global pandemic, majority of the lenders want at least 10 to 20% of the down payment. Sometimes they're giving you, let's say, 10% or even 20% of the down payment or 15% of the down payment. And their situation might be such that, let's say, they booked a property from the builder a few years back, and they put a 10% down with the builder. And now at the time of purchase of the property, for whatever reason, they are not qualifying for a mortgage. Maybe their job has been cut down, or their income has been reduced, or they are going through some personal problems like divorce or any other situation where they're going through such problem and they are not in position, or their credit rating has recently got a hit and got some collections or some problems where cannot qualify, or they don't have sufficient or good enough credit to qualify for a mortgage. So even if they have 20% down or 15% down, they're still not able to purchase the property. So in those situations, it's better for them to do a ALP lease option than to let the deposit go or let the builder forfeit the deposit. Many realtors or rent-to-own companies which are not too familiar with the system is they take the option fee as a deposit, and they would normally sign an agreement of purchase and sale with an extended closure or delayed closing, which can be 3 years or 2 years, and where it's considered this is as a deposit. The problem with that is, for example, it says within 3 years, the tenant buyer is going to buy the property for $345,000, and down payment is received as the closeout deposit. The problem is that now you have to keep that deposit in the trust account, in the lawyer's trust account, or if you're using a realtor, then you attest to the real estate brokerage trust account, depending on your jurisdiction. And if it's a down payment instead of an option, it appears as it appears in the agreement of purchase sale. I don't think we should do this kind of contract. The reason for that is very simple. Means if you are not receiving the option fee, you are just receiving the deposit. Why would you hold the property for someone for three years? Okay, why should you give someone an option to purchase the property in 3 years when it's only the deposit, not the option fee? Option fee is non-refundable. Okay, deposit, you might have to refund it. In that case, if the cash in the trust account is in the trust account, it's going to be very hard for you to get it from real estate board or real estate brokerage, and it's going to be an uphill battle for you to fight back to get that deposit. That's why take that risk? So normally, as under ALP system, this is simply considered as an option fee where the tenant buyer pays you the option fee directly under the contract, and this is an option fee which is non-refundable. It's very important to mention that this is non-refundable because it will have tax implications on your income taxes, because if it's a non-refundable deposit, then the transaction will be considered as capital gains. If it's a refundable deposit, then it will be considered as normal agreement of purchase and sale. So it's very, very important for you to understand that. And on top of that means once you get the cash, it helps you with the overall cash flow and the profit. So the next is throughout the contract, you make money. And the way you make money is because the amount that you're receiving as your rental income and the amount that you're paying as your mortgage or as your property taxes, the income exceeds the expenses. Or even if you're doing a lease option, so it's more than your lease. So the difference becomes your cash flow and the profit. And on top of that, you get an added profit for yourself, which is normally included in the contracts. And also there is what we call the additional rent. The additional rent is the savings, a kind of boosted savings that we do for the tenant buyer, which also acts as your additional rent. So yes, down the line you will have to refund it, but it's a good amount of time. It's roughly 2 to 3 years where you will get to use those funds for any other investments or down the line, because all this additional rent and the extra funds that you receive, which you need to refund, you can pay it out of your profits in the deal already. So you're being paid in advance for the appreciation that's happening in the property, which is a fantastic way because you don't have to refinance it. You're already receiving the payments up front. Of course, you can go ahead and refinance it as well because the property is in your name. Yes, you can take out an equity. If there's equity, we would suggest taking that out and reinvesting. And so I think this is a fantastic way to get the extra cash flow in hand. On top of that, it helps you with when you're refinancing or when you're buying the next property, because of the added extra income that you have, it becomes your qualifying way simpler because you have more income than expenses. So it adds on to your income. In the normal rent to own or in the normal lease option, the result is opposite because the income hardly covers the expenses, and you're just making maybe $100 or $200 more. But because the banks or the lenders do not calculate the full income as the income, so what ends up happening is that each property that you buy becomes a burden rather than an asset in terms of the lender. So it makes your purchase of the next property very, very hard in those cases. So that's why under the ALP system, we have designed it totally differently, where each property that you buy will make it easier for you to buy the next property. When you own a property, I mean, there are other regular expenses such as taxes, insurance. So normally what we take into calculation is the PD, principal, interest, taxes, and insurance. So the monthly credit. So the way we do is we add the PD and the additional rent. And if we work with the tenant with a boosted saving plan, which under the normal rent to own, they call that forced saving. I don't like the term forced saving, so we call it boosted saving. The reason for that it's forced saving is they're forcing the tenant to pay extra each month. Whereas in the ALP system, we encourage the tenant buyer to save extra because the more they put down as the additional rent, the more credit they're going to get. So we give a good return on their money. So this helps the tenant buyer because they can genuinely see the system helps them speeding up the speed for accumulating their deposits. So let's say the total cost of PT is $1,600, for example, and we suppose the tenant buyer is buying the house $100,000 with the added appreciation. After 3 years, it's going to be $330,000 or $340,000 after 2 or 3 years. So if the client is paying $16,500 as the deposit, and let's say they will qualify with the lender, not 5%, and the banks might require them to put 10% down because of COVID. So they might require another $16,500. So the way it's done is that the balance $16,500 is divided into 36 months. Let's say it's a 3, so they will need roughly $460 a month as additional rent. It becomes very hard for the tenant to afford the additional rent. But if we subsidize that saving by giving them the incentive, let's say they need to save $460, and let's say we give them under our terms, we give them an incentive. Let's say they pay $300 and we'll give them another $100 for that. They will happily do that. And we have seen our tenants paying us $1,000 or $1,500 extra because it helps boost their savings. And it cuts short the period of rent to own period, and it helps them save. Any serious buyer, if they have the cash flow and if they have the resources, they will definitely go ahead with this boosted saving plan instead of the forced saving, which is normally applied in the normal lease options or rent to own agreements. In a normal rent to own or lease option, there's a forced saving which is around $200, and there's no added bonus to it. So normally they're forcing the tenant buyer to pay the extra $200 or $300 each month so that they can force them save enough down payment. What we have experienced that forced saving doesn't work. The way we do is very simple. We do is what we call this boosted saving program. The boosted saving program works is the more the tenant pays us as the additional rent, the more bonus we are going to give them. So for example, let's say the tenants pay above $300, they will get another 30% on that $300 as added bonus for paying the $300 as additional rent. So let's say, for example, the tenant pays $500, they will get 30% of it with $50. So the total saving for the tenant is going to be $650. Nowhere else they can get 30% return on their money. So any smart tenant, any smart buyer will happily do that. And if they pay over $600, it will be a 35%. If they pay over $900, it will be 40%. And if they pay, let's say, over $1,200, it will be 45%. So this boosted saving helps the tenants save more money. So let's say the tenant maximizes and pays for extra $1,400. They receiving another $630. So they will be each month saving $2,000. Okay. Yes, you may think that it's cuts into your profits, but our goal at the end of the day, as when we started this program, was to make sure that we are really helping others, that we are really helping them. Don't worry about your profits at this moment. Once we do the full calculations, you will notice that this is one of the most profitable deals, not only for you, but also for the tenant buyer. And it's fair that both of you will win big by doing this way. And so this gives the tenant buyer an added incentive to give you more additional rent. And the beauty is with this, now because you're receiving a lot of extra rent from the tenant, it helps with your qualification for your mortgages, because you have more income coming, more cash flow coming, and it helps with your cash flow as well. And it helps you purchase more properties. So overall, you win and they win. So you now have a good cash flow because you're receiving, let's say, $1,600 or $1,800 plus an extra $300-400, and in some cases that will be extra $1,000 credited each month to your account. And don't worry at this moment, because it's your current cash flow. It's helping you with the cash flow. It's helping you with qualifications of the other properties. When in the end, let's say in 3 years, the tenant buyer succeeds in buying the property, there will be enough savings out of the added appreciations to pay for all of this. So it doesn't cut back into your profits tremendously. So it in fact gives the tenant buyer an added incentive to do the deal with you, and they're happy because you're helping them save, and you're really genuinely helping them give a good return, where in no other circumstances will they ever get it as a tenant anywhere from somebody a 30 or 40 or 50% return on their money. So under the ALP system, the investor buyer will use the additional rent to in case of default. So let's say something happens, or some accident or something serious happens, and the tenant buyer is going in default because they have been paying added rent, additional rent. So under our ALP contract, we want to protect the tenant buyer. So in case of default, the first thing is we deduct the funds out of the additional rent. So this way, your payments don't go in default because your reserve for the additional rent goes down. Of course, the tenants lose the credit in case they go in default for the additional rent for that month that they are not there. So they will lose that additional credit. They don't lose everything, but they just lose for the period when they are in default or when they are late for the payment. They lose that additional boosted saving incentive, because it now pushes the tenant to pay on time, because otherwise they will lose the incentive of the bonus. And so normally it's on the 3rd of each month. Let's say the rent is due on the 1st, and if the tenant does not pay by the 3rd, they will lose the boosted saving bonus. So this pushes the tenant to pay on time. So you don't have to chase the tenant, because tenant has enough incentive to lose in case they don't pay. Not only they lose the 30 or 40 or 50% additional rent that they were going to receive as credit from you, but they also will have to pay the penalty in the contract for the late payment. So this kind of adds up in case they are not punctual. So this pushes them to become punctual. And this is normally non-existent in the normal rent-to-own agreements or lease option agreements. So ALP system is way better than the other systems on the market, and it helps protect both the tenant buyer and you, because the additional rent acts as an additional security so that the tenant buyer doesn't go into default just in case life happens, and it acts as a buffer so that in the good times they save to help them in case bad times happen, and which sometimes do happen in life. So administrative fee, because you're helping the tenant do the rent to own or the ALP system, there's an administrative or management fee which is added as your profit. So it's roughly, let's say, $250 a month. So over 36 months, it will add up to, let's say, $9,000 of profit for you. And this is another perfect way of getting an additional income for you to cover your expenses and managing the property. Sale of the property. Let's say, for example, you negotiate a purchase price of $300,000 and you sell it after 3 years for $345,000. So you make a profit of $45,000, which is a very good profit just on the appreciation alone. On top of that, you will have an extra added profit out of your monthly profits that you're receiving out of the rent and the additional rent that you're making, that they're making to you, so that will be as an additional cash flow to you. And the difference, let's say you bought the property for $300,000, you're selling it for $345,000. So you have a profit of $45,000, which is your fixed profit. But because we have agreed with the tenant buyer that we will do the appraisal at the end of the term when they are purchasing the property, and whatever is the difference, we'll split it between them and you as the investor. And this has a few benefits for both the tenant and both the buyer. We'll discuss it in the next slide. ALP system is designed in such a way that it wants to lower the risk for the investor, and it wants to earn enough income for the investor, but at the same time, it wants to help the tenant buyer achieve what they set out to achieve, which is to purchase. So it helps them save extra money. It helps them cut down the expenses wherever possible. It helps them get the boosted saving bonus, and it helps them split the difference. In a lot of rent to own contracts, the way the deal is done is that when the deal happens, the appraisal is done, and the property is being sold at the appraisal, because the tenant maybe has defaulted for a month and they have such clauses, which is not, according to me, very fair. So in ALP contracts, we very distinctly, we want to be very fair with the tenant buyer. We want to help them. The main objective is to help them achieve what they set out to achieve. So the way it's done is, we want to encourage them to give us the bigger deposit. The bigger the down payment, the bigger the option money they are giving upfront, the lower is the risk. If the bigger the down payment they pay, let's say, for example, if they pay 5% down payment, the appreciation is around 5.6%. If they pay 10% down, the appreciation is reduced to 4.6%. And if they pay 15% or 20%, then it's reduced to 3%. So there's a scale with which we work. Is the bigger the down payment, the lower is the appreciation, because as investors, our risk decreases and our rate of return increases with the increase of the down payment from the tenant buyer. Okay. And you might be surprised that a lot of tenant buyers, because of this, are willing to pay. Ex-tenant seller is in distress and they're about to lose their house. They have enough equity. And now they meet us and we strike up a deal that we will buy the house from them because they have children going to the school in the same area and they don't want to lose the house and they don't want to move out of the area. But if they are foreclosed, if they are being forced out of the house, not only they will lose equity to the scrupulous lawyers and to the foreclosure procedures, but they will have to move out of that house. But with our system, the ALP system, the way it's done is that their equity is transferred, and the bigger equity they transfer to us, the lower appreciation will add, so it will be cheaper for them overall. And that's helped them in big time. So a lot of tenant buyers might have 10, 20, 30%. And they might end up saying, okay, I'll pay you 10% or 15%. And the rest they will get as cash back at the time of the transfer of the property from them to us as the investors. And then they will become as tenants under the tenant buyer ALP agreement. The next thing that happens is by putting more down payment, it becomes more savings for the tenant buyer, because the way it's done is that the bigger the down payment, the bigger their split is going to be of the difference. The difference is calculated the appraisal value minus the appreciated value after adding the appreciation. So whatever is the difference, so let's say we buy a house for $300,000 and after 3 years we are selling it for $340,000 or $345,000. But due to good market appreciation, now the house is worth, let's say, $380,000. So there's another roughly $35,000 profit. Or another, it can vary, especially in these days due to the hot market, where the market is appreciating around 10% in the Toronto area or in Greater Toronto area or in Ontario overall. This can be a very good thing for the tenant buyer and also for the investor. The investor gets to make an extra profit, which is normally with the amount of down payment or with the amount of investment that the investor has to make. The bigger the investment the investor has to make, the bigger the share is going to be. And so it's going to be from anywhere from 1/3 to 50%. So anywhere more deposit, the more down tenant buyer pays, the bigger the difference they will get as the creditors to them. So on the sale of the property, when finally the agreement of purchase and sale is signed and the appraised value is done, now the tenant share, the investor receives his investor share of the difference, the split is done. And so the tenant buyer now receives a credit for the option fee, which was the initial deposit. Number 2, the additional rent that they were paying each month. And then they're getting the boosted savings bonus, which is paid to them because they were paying the additional rent. And then on top of that, they get the tenant share out of the split, and which helps them save for the savings as the down payment. The selling price is, instead of being the appraised price, the selling price now becomes the appraisal price, because the tenant is getting his share and the investor is getting his share, because the property is being sold now at the appraised price. So this helps both the tenant buyer and the investor in a significant way. Number one thing, it helps to keep neighborhood prices from dropping down drastically, because the tenant buyer is buying at the market price. Secondly, built off of the equity due to appreciation and the difference between the market value. Now the credit of the tenant buyer increases drastically, so they will have bigger down payment to qualify for a mortgage. Of course, there's a negative side of it is that the now will have to pay more taxes because they are selling at a higher price. But don't forget, they are getting the split, which is minimum 33% up to 50%, which offsets their capital gains. The capital gains are normally maximum 50 or 50%, which is 25%. So it helps offset the capital gains and it gives them an additional profit. So in case the market price does not increase, the tenant buyer still benefits because of this incentive, the investor adds more appreciation. So the tenant buyer will end up buying the house cheaper in case the market price did not increase. But if the tenant buyer does good renovations, keeps the house in good condition, takes care of the house, does whatever they need to do to add value to the house will go up in value and the tenant buyer will gain and the investor will gain. So if the tenant buyer invested, let's say they made a basement and they invested a significant amount in making the basement and all that, and the value is going to go up. So should they be still giving a share of that? The way it's done is the difference, then the actual receipts of the investment are deducted. So that way the genuine appreciation is left. So let's say the overall market up $100,000. And so the difference, which is going to be split between the both tenant, and let's say the tenant buyer has spent out of his own pocket $30,000 on finishing the basement, so the split will be done on the $70,000. Remember, the system is designed in such a way that it is beneficial to both the tenant and the buyer. And the principal pay down, the longer the period, the monthly payments are going to be made. Each month the payment is being made. The principal is going to be paid down along with the interest. The interest is paid, whatever is in excess of the interest is being deducted out of principal. So for instance, there could be an extra $10,000. If your house is $300,000 and over 2 or 3 year period, an extra $10,000 principal might have been paid down, depending on your credit score, depending on the amount of interest that's being charged in the mortgage and the depreciation time, the amount of principal that's being paid down. Who benefits from this principal pay down? If you own the house and you have bought it for the tenant buyer in your name and now you are selling, or in your company's name and now you're selling it to the tenant buyer, then obviously you gain that principal. But if you are doing a sandwich lease or sandwich lease option, so then your seller from whom you're leasing the property, they gain. So it helps them also. Let's say they had a $30,000 equity in their house, and now because you've been paying the monthly payments and now the principal got paid down by another $10,000. So which is a fantastic way. They got another 33% return on their investment on their equity. So instead of selling the house and taking the equity out, now they kept the house. They kept that equity in the house and they got 33% return on that. And sometimes it can be more. So it depends on really your terms and how you are set up and what kind of interest rate you have. And so it can help both parties, all the parties involved. Option fee and additional rent credits and the boosted saving credits. So don't forget, once the contract is completed, your tenant buyer succeeds and is ready to buy your house from you, and now you will have to give them the credits. So let's say they have put a $16,500 deposit. Now they were giving you the extra additional rent, plus you will give them the boosted saving bonus. So and plus whatever the appraisal value might come up to, and then the difference they're split. So it helps the tenant buyer save a lot of money, and it helps them accumulate the savings. It helps them increase or boost the amount of their deposit, and they might qualify, instead of, let's say, normal 3 year, they might qualify to purchase in 2 years. So this helps them, because now they have saved a year's worth of rent. Now the property is being transferred to them, and now they will gain from the future appreciations, and they can now stand back on their feet. So this helps everybody. It becomes a win-win situation with the ALP system. The ALP system is designed in such a way that it helps you as an investor make you more money, and it helps the tenant buyer make more money.